June will mark the 10th anniversary of the end of the Great Recession. However, as memories of the crisis recede, investors have grown more nervous in anticipation of the next one. Perhaps the jitters are justified as 77% of economists expect a recession by the end of 2021. That, according to the National Bureau of Economic Research. Although the past two recessions gave us severe market conditions, not all recessions trigger market crashes. Yet, it still pays to be wary of any recessionary event. So here's a look at four lesser known economic indicators that offer reliable clues about a potential future slowdown. Let's take a look. Yields, yields, yields. For 5 days in late March, the 3-month Treasury bill paid higher interest than the 10-year note. This was the long dreaded inversion of the yield curve, which cast a gloomy cloud over many investors' outlook. This event is one of the main omens economists rely on more than any other to predict recessions. Normally, long term bonds pay more because investors are willing to hold on to a bond for a decade only if they're compensated more for the patience and risks. So the curve is positive. However, once in a while, investors become convinced that interest rates and stock returns will be so low in the future that they're better off buying long term bonds now to lock in today's yields and own an asset that will be less risky than the alternatives. As a result, they buy more, driving yields below short-term rates, and the yield curve goes negative or inverts. It's a phenomenon that has preceded the past 9 recessions since 1957, according to economic data from the Federal Reserve. However, note that flat or inverted curves have also generated at least 3 false alarms. Even should the yield curve invert again and stay inverted, based on previous experience, investors will still likely have about a year before a recession hits. Are you still driving that clunker? U.S. auto sales returned from the Great Recession lows, but today, car buyers aren't doing as well. At the end of 2018, more than 7 million Americans were in serious delinquency, or 90 days past due on their auto loan payments, according to the Federal Reserve Bank of New York. That total represents an all time high, and any further spike may cripple the broader economy. According to the New York Fed, the numbers indicate not all Americans have benefited from a stronger labor market. Cash strapped borrowers aren't the only destabilizing factor. With some big banks like JP Morgan, Chase, and Wells Fargo backing off from auto loans, non bank lenders that specialize in auto finance have filled that void. With less regulation, underwriting standards have been loosened. That is not a great formula for success. Deja vu, anyone? Anyone? Once again, that wonderful country, China. Over the course of a single day in January, Apple lost about $74 billion in market cap after warning investors that spending in China was slowing. Investors in Ford Motor Company and Japanese electronics giant Panasonic had similar experiences. The usual barometer of a nation's economic health is the gross domestic product. It's widely seen as generally unreliable in China. Oh, what a surprise. Local governments in China are rewarded for hitting growth targets set by the central government, and so they self report impressive numbers. No room for cheating there, I'm sure. Earlier this year, Chang Tai Heiss, an economics professor at the University of Chicago, co authored a paper making the case that China had overstated GDP by about 15% in 2016. For a more trustworthy indicator, many investors look at household expenditures and personal income data published by China's National Bureau of Statistics. The current story is that the Chinese consumers are cautiously upbeat and won't be the trigger for the next recession. For now, investors should watch if income growth lags China's reported GDP growth rate. Don't worry, you're paying me to do this, so just sit back and relax. And lastly, you should follow corporate profits. For decades, it's been one of Warren Buffett's guiding principles. When corporate profits swell to a larger share of GDP, the competitive nature of capitalism exercises a gravitational force that pulls them back to historical norms. And then profitability shrinks and stock returns become sluggish or worse. By some measures, Buffett's gravitational shift is already underway. U.S. earnings peaked at about 11% in GDP in 2012, but in the fourth quarter of 2018, they still accounted for about 9.3%, or still 2.6 percentage points higher than the 60-year average, as you can see in this chart here. This indicates that profits may have further to fall. The fall in profitability reflects a tipping of the balance back toward labor. Since the year 2000, the share of GDP going to salaries, wages, and bonuses has dropped from 46% to 43%. Lately, though, that trend has begun to reverse. The tightening labor market, as evidenced by the low unemployment rate, is why wages are growing at about 3.1%. The expectation is that these trends will continue pressuring profits and suppressing share prices across the economy. Now, this may not be good for the stock market, but at least the employees may have more money to spend. So, for you as an investor, keep your eyes out on these four factors. For today, that's ChewDog Charts. Thank you.